Some people might think that in order to profit from investing, you'll need years of experience and preferably an education related to economics, which actually isn't the case at all. In today's video, I'll be going through the easy way of becoming rich, where you guys will see how simple investing can be done, and I'll show you some examples of it. It doesn't have to be hard, and following these tips, you should be able to make some nice profit from investing. In the end of the video, there'll be 3 examples of a portfolio setup. First point is diversify. So first off, you've probably all heard of this one. You need to diversify. And yes, this is right. But what exactly does it mean? Diversifying doesn't mean to invest in 10 to 15 different finance stocks or 10 to 15 different restaurant chains. Even though you might think that you're diversifying, here you're diversifying across a single sector, which is also good, but in order to do it this way, it will require way too many stocks in a portfolio, because in order to diversify, you'll need to spread your money across a lot of different sectors in the stock market, and preferably also have a few stocks from each sector. This right here could be an example of a diversified portfolio. You spread your money out on a lot of different sectors and preferably also a lot of different countries. But a stock portfolio like this could easily require about 50 to 100 stocks, which is way too many stocks to pick. So yeah, diversifying might actually require a huge stock portfolio and way too many to keep track on. This is also why I'm making this video. It can be done in a very simple way that will limit your risk and make sure you have a portfolio that is diversified and will generate you a nice return. Comment down below if you want a deeper look into my portfolio and how I'm diversifying in a future video. Okay, next up, let's talk about an ETF. Now we know we have to diversify, but how do we do this? So we have the greatest chance of making money with limited risk of losing money. It is actually really simple, and you'll only need a few things in your portfolio. And this is through ETFs. What exactly is an ETF then? ETF is short for Exchange Traded Fund. It is like stocks, and they're traded on the different stock exchanges and can be purchased and sold just like stocks. ETFs will hold assets like stocks, commodities, or bonds, depending on what type of ETF you're purchasing. A lot of ETFs are made to follow a certain stock or bond index. Some of the most popular ETFs tracks the stock market. A lot of them will follow a certain national index, for example the S&P 500. So here you'll buy an ETF that will then follow the S&P 500, and instead of you having to buy all 500 companies in the S&P 500, you'll only have to buy this one ETF. Which is a great way to diversify your portfolio with limited amount of work and research. So what is the catch here? Well, yeah, ETFs has a catch, and it is that you have to pay a small fee every year in order to pay for all the work someone else have to do in order to make these ETFs, but this can be as low as 0.04%, but we'll have a look into that later. So, what ETFs to pick? Yeah, now we have the same question as many of you might have with stocks. What ETFs should I pick? There's so many different ETFs out there, and some of them might look similar, and some of them you might have no idea what stuff they're actually holding on to. Here you can use a site like BlackRock. On BlackRock, you can get an overview about an ETF's price, daily return, yearly return, and annually price. Then you can also have a deeper look into their performance, some of the key facts about the ETF, just like a stock, some of their characteristics, even their sustainability characteristics. Then one of the important ones, their fees. And this one varies a lot, but I'll show you some examples later. And then one of the most interesting points, their portfolio, or what could become your portfolio. Here you're able to see all of the companies that is in this ETF and the percentage of each company. This percentage is made to follow the markets that they're trying to follow, so you'll know exactly what you're investing in. Some ETFs have more than 1,000 stocks in them, so you probably won't want to read all of them, but it also gives you a top 10. And no, this is not a top 10 about the 10 best stocks, but it is the 10 stocks that they have the highest percentage of. It also shows you a map where you can see their spread across countries. And then lastly, all the literature. Now I told you guys that it's there, even though most of you probably won't ever open any of these files. Oh well. Okay, so now we have gotten this file, but still, which one should you pick? So yeah, we're doing this in order to diversify. So now I've made 3 examples on how a portfolio could look. Okay, so first portfolio, this super simple portfolio. This first portfolio actually only holds one ETF and nothing else. Diversifying? Well, this is the great thing about ETFs. You don't have to buy that many different in order to be diversified. But here, the only ETF in the portfolio is iShares Core MSCI World ETF. So here you are able to spread out your portfolio across the entire world with only having to buy one ETF. It holds more than 1,200 stocks spread across a lot of sectors in a lot of different countries, and the fee is only at 0.24%. Your largest position here is in the US, which corresponds pretty well to how the market is spread out in general. Historically, the overall market has grown about 7% per year for the last more than 100 years. So you could expect this portfolio to be somewhere around the 7% mark as well. But remember, historical gains doesn't guarantee future gains. But if you want to make investing as simple as possible, this could be how your portfolio could look. Next portfolio, I'll call it the American. The American stock market have grown 9.8% since 1928, which is actually pretty insane. So if you think that this will keep on going, this is the portfolio for you. Here you buy probably around 70 to 80% of iShares Core S&P 500 ETF, which, as you probably guessed, will follow the S&P 500 index. This ETF has one of the lowest fees you can find at only 0.04% per year. So basically it's free. Here you buy some of the biggest companies in the US and hope their rise will continue. This is the first ETF in this portfolio. But next up, you have to buy the last 20 to 30% of iShares Factors US Value Style ETF. This comes at a price of 0.25%. This is an ETF that, as they states, value index that provide favorable exposure to 5 proven drivers of return: financially healthy firms, stocks that are inexpensive, smaller companies, trending stocks, and lower volatility stocks. So these aren't the companies you'll have the biggest percentage of in your S&P 500 ETF, but these could have a nice potential for some future growth. This portfolio will diversify you across the US with a good potential of some nice growth. The last example of a portfolio is the all-rounder. Here you want to diversify your portfolio on a lot of sectors and a lot of countries. But you want to pick out your own percentage of how your portfolio is spread out on the different sectors. Here you also have the iShares Core S&P 500 ETF to spread out on the American stock market. This might be around 45% of your portfolio. Then you have about 20% iShares Europe ETF to be a part of the European stock market. This ETF is a little bit more expensive with a price of 0.59%, and my personal recommendation would be to stay around 0.5% or lower. So you might see if you can find another ETF that is a little bit cheaper. Then you could have about 15% of iShares Core MSCI Emerging Markets ETF, which will spread your money out in Asia, Russia, South America, and then a little in South Africa as well. With these three ETFs, you'll spread your money across the entire world and you're able to pick how many percentage you want in each market. These three combined only equals 80% with the percentage I just said, and this is because the last 20% can be used in sectors that you think have the biggest potential right now. Here you are able to find an ETF that holds stocks in a specific sector. So if you think that the information technology sector will keep on rising, you could buy an ETF like iShares US Technology ETF, so you're able to get a part of all the biggest IT companies in the US. This might be 10% of your portfolio, and then maybe the last percent in something like iShares Nasdaq Biotechnology ETF if you believe that the biotech industry will keep rising. This is just to show you that you're able to find ETFs that fits the sector you want to invest in, so you won't have to be worried about picking the wrong stocks in that specific sector. This one was the last portfolio, and remember, these are just some examples of how a portfolio could look, and you have to decide on your own what you want to invest in. I hope this video helped out you guys, and please make sure to subscribe to my channel and like the video if it did.